So just to toot our own horn here for a minute at FREOPP, we have been obsessed with inflation for a very long time, even when it was transitory. And so that's why we're effectively having an all FREOPP panel here, because we have made this a real focus of our work, and we are very fortunate to have three scholars here who have done have incredible expertise in macroeconomics. John Hartley, who is a research fellow at FREOPP and is a PhD candidate at Stanford in economics. We have Matt Klein, who has been a columnist at the Financial Times, The Economist, Barron's, runs a Substack called The Overshoot, which is one of the most widely read. Every major economist, follows this Substack, which is pretty incredible on macroeconomics, called The Overshoot. And Daniel Arbess, who's one of the most accomplished investors of his era, an incredible life story and bio, who is also got a great market-based eye on all this stuff. So, I think you all are going to benefit a lot from this. Let me start with you, Dan, at the end there. It's partly kind of an ageist thing that I'm going to do here, Dan, because you're old enough to remember the last time we had a major era of inflation. How do you look at the parallels and differences between the 70s era inflation and what we're seeing now?
Okay, good. I'm very happy to be here. Thank you for having me, Avik. It's really good to be with you guys. And I'm a paid subscriber, Matt, so thank you for that. I don't think that the 70s inflation is particularly relevant right now. And in fact, I have some good news for you. I think that inflation for the current cycle, if you can call this a cycle, has peaked. Guess how much the NASDAQ stock exchange is up today? 5%. The S&P is up 4%. That's just crazy, to be honest with you. It should never be that way. But people are wandering from one pole to another across every area. I was in the welfare session just before. I was in the foreign policy session. We all have the same problem. We need to think up the directory of what's driving what. So, as I think you know, my view is that inflation is not really a huge problem right now. Inflation is, as Milton Friedman always said, primarily a monetary phenomenon. It's a question of how much money is in circulation relative to, as Matt has written extensively, supply and demand for products and services. I think we have been for the last 15 years in a disinflationary overall economic environment characterized by job displacement and automation improving operation efficiencies. And so the labor market is still where it was in the 70s with the participation rate just above 60%. The only jobs that people can't fill are ones, frankly, that people don't want because they don't pay enough for the, for the stress, like nursing. So I think we're in a very different environment right now, and I'm much more concerned about the fiscal situation, which maybe we come to in a second.
Yeah.
But for the moment, the inflation has three components. The current round of inflation. One is classical monetary. Unlike QE, and the whole key to inflation is where the money that's created goes. In QE, I was positioned for inflation. I bought gold and made a lot of money quickly, but then by the end of the first year of QT, I did an interview with the Financial Times online and said, this is it. This is all that monetary policy can accomplish now. We need to move on to some fiscal policy. Never dreamed in a million years that you would have QE continue as long as it did, and then eventually morph into MMT. That was inflationary. QE, the money stayed in the banks, in the financial system, raised the wealth and created more inequality, which is a different topic. MMT during the pandemic was real money printing, sending checks into the economy. That was inflationary. as Matthews pointed out, wars are inflationary. They restrain supply of commodities. The trade war, Trump's trade war, was inflationary because it upset supply chains. All those things are what I call event-driven. They will be worked out, and they're in the process of being worked out in the private sector.
Yeah, let me for the non-economists in the room, just because we dropped a lot of acronyms already, which economists love to do. Let's just to kind of boil it down. And John, you tell me if I have boiled it down incorrectly. But effectively, one of the major things that's happened over the last really 14 years since the financial crisis, but certainly also during COVID, is that the Federal Reserve increased the quantity of dollars in circulation. When you increase the quantity of dollars in circulation, but the economy stays roughly the same size, to oversimplify, then each of those dollars is worth less in purchasing power, and that is one form of inflation. That's really important. Now, John, you wrote an article for, I believe it was for us, maybe even for National Review, I can't remember, about one of the quirks in the way we actually officially measure inflation through CPI and PCE, in that the housing component, which is a third of the way of the consumer basket for the way we measure inflation, is measured inaccurately, and therefore there's just kind of this funny lag of how the number that we call inflation is going to continue to be high even if actual inflation starts to decline.
Oh, sure. Well, thank you. Yeah, I think. I don't know if I would necessarily use the word inaccurately. I think there's different schools of thought in terms of how inflation should be measured. One, I think it should be like totally emphasize how important housing is to inflation. Inflation or housing makes up about 33% of the broader CPI basket, and when you just think about core inflation, so that's taking out gas and energy. That it makes up about 40%. So this is really important. How we measure this does have a serious impact on our actual inflation numbers. Now, there's sort of a debate about, to what degree housing is consumption versus investment, like fixed investment, thinking about like investing in factories and things like that. So essentially our friends at the BLS, who are near Union Station here, sort of had this way of the Bureau of Labor Statistics. I'm sorry, too many acronyms. They sort of decided that we were going to sort of split up housing costs. One, that they were going to not look at housing prices, but that they would look at rent, and not just all rent. So if you're renting an apartment here in Washington D.C., they're not going to use your entire rent bill in terms of how much to weight rent in broader CPI, but only the amount that they can sort of justify as what they call owner-occupied rent. So there's rents. I'm not going to get too into it, but essentially they're just using a certain component of rent in CPI instead of housing price. So what happens is your rents tend to follow housing prices at a lag. And what happens is when there's massive swings in housing prices, like we've seen, especially in the post-pandemic era, where a lot of people were fleeing to suburbs, bidding up the prices of single-family homes, what happened was, we saw some really big surges in housing prices, like 20% increases nationally. And it takes time for rents to adjust because rents are kind of sticky. And so what's happened is they've been following CPI or the CPI has been following housing prices, a bit of lag, and this has played a huge role in terms of, in my opinion, unduly kind of influencing monetary policy. Because what happened was, last year, I think it's really important. Dan, you talked a lot about the future going forward. The crazy equity gains today, and the new inflation prints today. That it seems like inflation is cooling down. I think it's so important that we actually talk about how we got in this mess to begin with. It's like the same thing with COVID. Like, we have to talk about how did we get here to these disasters. And I think that the flashpoint was really in October of 2021. May was when things CPI first started spiking up, and people would point to certain components of CPI like used cars and perhaps used car prices, and perhaps that had to do a lot with supply chain issues and chip shortages that are needed for new cars, and new cars weren't coming off the line. People were buying up used cars and all this. But in October of last year, the Fed kind of had no more excuses that inflation was transitory, because what started happening in October was how this rent component of CPI really started or owner-occupied rent started just jumping up dramatically. And that was the moment where it was just very clear that this was going to become an entrenched thing, because housing is like this this very difficult ship to sort of steer. And once it starts moving in a certain direction, I think it's very difficult to move away. We may now actually be in the opposite direction.
How are home prices doing right now?
Well, home prices are so now we're in the exact reverse. So you're absolutely right. So prospectively, what's happened now is home prices are falling dramatically, but now rents haven't been falling, and rents are catching up. So when we think about inflation numbers, the housing component of that is just reflecting rents, not the latest prices. So I think kind of to your point earlier, it's not enough just to follow CPI. I think it's important to think about other sort of leading indicators that may forecast how that housing component can change in the future.
Matt, go ahead. How would you compare the 70s to today?
Thanks, Avik. Yeah, there's a lot of things to get into. I mean, in the 70s, understandably I agree with Daniel. That was a process that actually began in the 60s. It was a very long, slow build, really started in like 1966. Nixon put in wage and price controls because inflation was a problem in 1971, which is well before a lot of what I think in sort of our popular imagination we think of when the inflation problem in the 70s actually began. And then it continued again for another 10 years after that. That inflation was very much characterized by, there were certain supply shocks that occurred, particularly in the energy complex, but it was mostly being driven by the fact that wages were growing at an accelerating rate that was driven by the structure of the labor market at that time. It was driven by the combination of the expansion of the welfare state and the spending on the Vietnam War concurrently. Lots of differences with today. What happened this time around, and I'm not going to give the full summary, but I think it's pretty clear if we can all go back and remember that the pandemic was extremely disruptive. It was disruptive both to the things people wanted to buy, or what they were able to buy, and it was very disruptive for our business's ability to produce those things. And you have that kind of disruption, it's going to lead to big changes in prices. It's going to lead to big changes in what people are earning. The government could have done nothing to support incomes of people who are not able to work. The dentists, the waiters, the people who worked in movie studios. That would have led to a Great Depression level event. It would the kinds of losses we would have had in terms of unemployment, in terms of bankruptcies, in terms of foreclosures would have been so much larger than anything we experienced in 2008. And over such a shorter period of time, that was socially unacceptable, which is why there was a remarkable consensus in this country to prevent that from happening. And instead what we did wasn't perfect in the implementation of the targeting, but the basic idea was that the government would ensure that people would have enough money to continue to be able to pay their bills, and that no one, hopefully would be forced into penury because of the fact that we're all trying to avoid getting sick. And that more or less worked. The problem is, of course, if you've produced fewer things and you've also reduced your productive capacity because of all the businesses that shut down early on in the pandemic before the government money was distributed. You can look at concretely things like oil refinery capacity shut down when oil prices went negative. All the people who used to work on drilling crews laid off, the pilots who were put into early retirement. All of those things, there are many other examples you can point to. It means that once the economy starts to heal, once you have vaccination and you have people being able to reopen, that's a very unfortunate combination in terms of you're going to have some kind of adjustment one way or another. And the way it shows up is inflation, that there was more income available, there was fewer things available, less ability to produce and adapt, and that showed up in the form of price increases. I mean, the good news is, I think that should end, the process should end. I mean, it's taken longer than I would have hoped. I think other things have happened to sort of prolong that adjustment process, but the optimistic view is if you look at what actually happened in the real world, and you think about the magnitude of price increases we've experienced and delivery delays and things like that, it's actually been, I would say, pretty small. And we take this sort of the big picture view, the relative to the shock that our society experienced and that globally the economy experienced, that businesses handled it and adapted relatively well, all things considered. Now, the danger is that you have underneath this some sort of self-sustaining pressure accumulating, like what you saw in in the 60s and 70s, where for unrelated reasons, whether it's because of the money that was distributed originally or the fact that the economic recovery in 2021 was relatively strong, that then wages start accelerating in a way that inflation becomes self-sustaining. I think that you see that very clearly in the numbers on rents. Now, it's important to bear in mind that the numbers we're talking about in terms of inflation rates, if you're looking at it that way, is more in like the 4 to 5% a year range, as opposed to when inflation, the headline numbers we were seeing earlier this year of 10% or 11%. So the perspective is in order there, but I think that's sort of the concern. I think that's why policymakers have sort of tried to adjust. I think even there, maybe there's a case that may also be sort of reflection of one-off changes. You have so many people changing the industries they work in, changing their jobs, changing the terms at which they work, and that might very well fade over time as well. But I think the case there is a little more ambiguous.
You mentioned, Matt, the inflation targeting, and for those who haven't followed this stuff closely, until relatively recently, the Federal Reserve had a policy of keeping inflation under 2% and tried to manage interest rates to keep inflation at or below 2%, and then that was changed to average flexible inflation targeting, or is it flexible average inflation targeting, FATE, where the average of inflation would be 2%, not a ceiling, and that happened coincidentally right at the same time we just had this massive rise in inflation, and so a lot of people, myself included, have criticized the Fed for that. But I actually want to talk about inflation targeting in a different way, which is all else being equal, in a world in which we have global markets, free trade, technological improvement, things I know, Matt, that you spent a lot of time writing about and thinking about, we should have disinflation or lower prices, right? Technology should make a lot of goods and services less expensive over time. Free trade should make a lot of goods and services less expensive over time. So in theory, prices should go down and living standards should go up. And my worry is that if the Fed is targeting an inflation rate of, say, 2%, what they're effectively doing is actually having a looser monetary policy than is appropriate, because they actually think we should have higher prices when, in fact, maybe in a natural free market economic state, prices should go down.
Just jumping quickly on that, I mean, I think that you're right that progress should lead to prices falling, but what they fall relative to incomes, which is what we've seen historically. So even if prices are rising at 2%, if incomes historically go up 3 or 4% a year, that is consistent with that. I mean, we can argue whether 2% is the right number. The view that they have is essentially that some prices need to go down more. Implicitly, that means some people's wages might need to go down more relative to others. And it's harder to do that if you say outright someone's getting a wage cut as opposed to saying they're getting a wage freeze. That's why they like 2%. That might be wrong, but that's sort of the argument there, I think. But
yeah, a couple things that I've been accumulating here, but just on this last point and on your question, what's creating inefficiencies and driving costs of things higher is bad policy. So you're talking about free trade, but it doesn't exist any longer. We have different trading blocks that are emerging with the full support and encouragement of our Secretary of the Treasury. We're talking about friend-shoring, trading with people who share our values, and I'm not one for rewarding anybody that's that practices bad human rights, but we are shooting ourselves in the head in relation to China. The dream for as long as I've been alive is that one day Americans can sell products to 1 billion Chinese. Now it's 1 billion for Chinese, and by fighting an unnecessary and non-existent trade war, we allowed the Chinese over that period of time to lock up all the raw materials that they need to create a vertically integrated internal consumer economy, and they are now buying oil from Russia and from Saudi Arabia denominated in yuan. That's nothing less, in my view, than the potential end of the whole petrodollar trading regime. So they have less need for our treasuries because they're not buying our oil. So they're not, foreigners own 35% of the treasury market. That number is going down. U.S. institutions are a little bit wary to hold treasuries when rates are moving up. And we have today's interest rates. I heard in the last session that the welfare state costs $1.2 trillion a year. Well, I'm here to tell you that's the interest rate burden on the federal debt that's at
Just
the
to
top
stop
of the
you
capital structure.
to give some explanation. So when foreign governments own treasury bonds, what they're effectively doing, that's a kind of that's their form of cash. It's like big dollar bills. But the effective result of that is to lend money to the U.S. When we have debt, people lend us money by buying treasury bonds, and that's why who buys treasury bonds matters, and how much they do.
Right. So, I mean, I want to go back to something that John said that I think is really important about the way that we count inflation for a second. Then I could go on and on and on, and because you know that, I end up going less than everybody else because you stopped me. But John, you said something before about measuring inflation, and I agree with you. I think that the way that we should be measuring inflation is the real impact of inflation on people's lives. So the small things that are immaterial to people who are wealthy, who have benefited, whether by design or consequence, from recent economic policies of the last 15 years, they can afford to pay $7 instead of $6 for a cup of coffee at Starbucks. But people who are on the lower end, who are on payroll, can't. So I think that our focus in measuring inflation should go to where the harm takes place, and we should be thinking about how to address that. But I still believe that all things being equal, which they're not, we are basically overall in a disinflationary environment for the reasons that you mentioned before, Avik.
Yeah, well, so I think that's a perfect segue to the FREOPP inflation inequality indices, which Jackson, Magia, myself, and other members of the team have played an essential role in contributing to. And essentially, what we're trying, what the goal of these indices are is to do exactly what you just outlined, Dan, which is essentially to measure the inflation rates for different income deciles. So those who are least among us, how does their consumption basket look compared to somebody who's in a higher income decile? And so, as it turns out, when you do the math and when you dig into the BLS, or the Bureau of Labor Statistics microdata, it turns out that inflation is on average higher for lower income individuals. So just there's the price of all the goods, the average price of all the goods that they're buying, just in general tends to go up a little bit faster in general. And a big part of this is because they tend to, essentially gasoline makes up a bigger fraction of their overall expenditures than more affluent people. And as a result, in part because gasoline tends to be more volatile, and certainly recently is risen pretty has risen pretty enormously until I guess it's settling down a bit now. But certainly, when Russia invaded Kyiv and elsewhere, it was rising enormously, and this had a very disparate impact on the port. When gasoline prices rise, but in general too, it's really important to remember that lower income individuals actually save a lot less and they consume a lot more of their income too. So you sort of also have to factor in this side of things, which is not only are their prices going up faster than wealthier individuals or higher income individuals, but also they actually spend just greater fractions of their income on consumption goods, and they can't save. In fact, many of them actually spend more than their entire income because they're borrowing. And so I think it's really important to measure these things, and at FREOPP we take it seriously and have created these indices. The FREOPP inflation inequality indices, and it's amazing how relatively little interest this has gotten from academia, the media, and elsewhere recently, and we're trying to sort of push the narrative on this topic. So.
You can go even further on that point when you talk about consumption at the higher end. I mean, do we really care if Hermes bags are getting more expensive? So we have to look at the things. The other point that I wanted to make relative to what Matthew was talking about has to do with the targeting of the PPP which was the inflation driver, the payroll protection plan checks that everybody received. I understand the
During COVID. Yeah.
I understand the circumstances didn't allow for very precise targeting, but an awful lot of people got money that they didn't need. Like during the pandemic, after those checks went out, you could walk down 57th Street in Manhattan and there'd be a line around the block to get into Chanel for people to buy bags that when you looked at the people, you could tell they couldn't otherwise afford it. They were spending their checks. Kids were buying NFTs. That's what was driving the digital asset, bubble. And so there was a lot of waste, apart from fraud, because there was a lot of that too. That's all use of money. But the point is, when government prints money and sends it one way or the other into the economy, that is inflationary. It didn't do that. I mean, it tried to do that with QE by conjuring money and then issuing bonds, but the bonds were then sold back to the Fed by the banks for cash, and the banks did not lend the cash as was originally intended. This is after the '08 financial crisis, because, well, for a variety of reasons. Instead, what they did was they invested the cash for their clients and others in financial instruments, which is why the upper end, those of us who were in finance, did so well, and to a large extent continue to do well through the second generation, which was outright inflationary, modern monetary theory, money printing, helicopter money, like sending money to everywhere. And
Yeah, if you want to know why there's a lot of wealth inequality, that's a big part of, at least from my point of view as well. That's one of the big drivers. And just as you said, John, I mean, if you haven't seen John and Jackson's research on inflation inequality, please check it out. It's amazing that you think about the academic profession in general. Everything is viewed through the lens of inequality, except inflation. It's the one thing where nobody's talking about how inflation drives inequality because, in part, it's the people on the economic left who are actually favoring the policies that have driven the inflation that we see today, which is a huge problem. I want to pivot a little bit to something that you alluded to in your opening remarks, Dan, and get Matt's take on it, which is you mentioned that one of the other drivers, we talked about increasing the quantity of money, some of the things that were like COVID emergency responses. There's fiscal policy too in general. I mean, it's the broader problem of the fact that we have 31 trillion of debt, of which we added 6 trillion in just the last couple of years. How much, not just today, but over our lifetimes, over our kids' lifetimes, is the rise of the federal debt going to contribute to these problems? Matt, why don't you go first?
So maybe I will disagree with you slightly on this one. I actually don't think that the quantity of the debt itself has an inflationary impact. I think what matters more is the total amount of spending in the economy, which is obviously affected by how much the government is distributing to households and businesses, and then whether they spend that, and then relative to the total productive capacity of the economy, both in the United States and our access to the productive capacity of the rest of the world through imports. And so, insofar as you might have a situation where the government is spending much more than it is taking back through taxes, that can be inflationary. Even then, though, it depends on sort of the structure of that. You could have a balanced budget, but if it's balanced by taxing the incomes of people who mostly don't spend on goods and services, people on the very high end of the income distribution, that would deceive you into thinking you have a non-inflationary budget when if you're taking from people who don't spend on goods and services and giving to people who do, that might be inflationary. Conversely, you could have a situation where you are lowering taxes on very high income people, having creating a budget deficit that might not actually be very inflationary. So it really depends on, I think, kind of those specific distributional questions. I think one thing, if the debt were to have an impact on inflation, I'm tempted to say that it might be somewhat disinflationary insofar as the interest bill on the debt is a salient thing that politicians can see. And to the extent that they react to that by trying to cut spending elsewhere or raise taxes elsewhere, that would, in practice, lead to less spending in the economy than otherwise, probably, and that would put sort of downward pressure on prices, I would think.
Let's take some questions from the audience, or think about your questions on us while Dan and John pipe in here. So if you've got a question, we'll take it. Let's hear from these other guys.
Let's take questions because we only have a few minutes left, and I would also say, as a matter of order, we're thankfully going into lunch, which means that we can continue to I'm happy to sit here as long as anybody wants to talk, because there's a lot of smart people in the room, and it's amazing how 3 guys could fill up 45 minutes so quickly with so little.
Well, windbaggery is our core competency. Who's got a question? Heather, go ahead. No, I'll repeat the question because we are recording this, so we'll just repeat the question. So just to summarize the question, given that not even on this panel, but certainly in the economic community, there's a lot of disagreement as to what's driving inflation. How is it possible for Americans to participate in the public policy debate of inflation when they don't really have an answer that they can trust as to what's driving inflation?
So one, I think that's actually an amazing question, and an increasingly important question for policymakers. And let me sort of just explain kind of why. So one, I think economics education is very challenging. If the whole MMT saga was any sort of a case study, it really just goes to show that really very few people out there seem to really care what mainstream academic economists have to say.
Explain briefly what modern
modern monetary theory, one, it's not a very well-defined theory. And essentially, one interpretation of it, I suppose, is that it suggests that you can sort of, print money endlessly as long as it's in your own currency, and that really only fiscal deficits, won't be inflation. You should basically
Print money and give it to people.
Print money, give it to. Well, I think there's really no agreed upon definition. It's basically spending as much as possible. They believe full employment is 0%. There's a lot of discretion. But I'm sorry, I don't want to get too sidetracked by the it's sort of like a quackery type thing, and more people seem interested in that in the broader electorate than what mainstream academic economists have to say. So one, how we get people to care about what mainstream economists have to say, I think is a challenging question. Two, I think it's just very there's a lot of disagreement about what's been causing inflation. I think that political narratives are increasingly influential. That breakdown 45, 50, 50, party line, whatever is being said on TV. All the center left and lefty organizations say that it's COVID, pandemic supply shocks, and Russia, and that's literally what's coming from the Democratic Party. And on the right, similarly, the right will say it's all fiscal policy and monetary policy, and maybe the answer is really a bit of both. But where I think it gets really important is where it starts to actually influence what the Fed does. So I think you have to ask yourself, imagine a scenario where somehow Donald Trump actually, was reelected in 2020, and we had some sort of inflationary shock in May of 2021. Do you think that the media would have given the Fed as much license as it did with the whole transitory narrative and promoting the idea that inflation was transitory for over a year and allowing us to get into the mess that we did? I think that if there was a President Donald Trump, I think the mainstream media would have tried to, totally, made a huge deal of things like the CARES Act, other fiscal stimulus that would have been, being promoted by and put forward by the Trump government in a hypothetical second Trump term. And so I think that, that these political narratives sort of give the Fed more discretion and the ability to sort of veer away from having a sort of prompt or response to things like inflation. And so I do think that there is some sort of strange political capture thing that's kind of gone on. I don't think that if say Janet Yellen or Ben Bernanke were in charge, I don't think that that inflation would have been allowed to run as hot for so long. I think that when you have a Fed chair who spends more time in Congress than any other past Fed chair in recent history, I think that kind of is a bit of a problem in the sense that it's not a compromise of Fed independence, but I think when the Fed chair cares too much about what other people think, whether it's in the media or in Congress or elsewhere, I think that becomes a real challenge.
Okay, John, with great respect, if I may say, the question was a simple question. How do we get people to understand something? And with great respect, I don't think that complaining about the media or the political environment or any of that is very helpful. You guys are a research and policy institute. It's your job to communicate concepts clearly, and that's why you're here. And I believe that Avik and you guys, you're all doing it. That's why I asked the question about, about sizing inflation to where it impacts. And so it doesn't have to be a long narrative and, casting, one of the things we do spectacularly in this town is look for someone to blame. Actually, that's one of the things that we do really well in this whole country is always find somebody to blame as opposed to like rolling up our sleeves and making it better. So my answer to your question is the way to educate people is to communicate as factually as possible without the noise of who's to blame and why is it hard for me to communicate this and that, just to say it and to say it clearly and repeatedly. And to
Matt,
engage people the way
let's
we're
give
trying
Matt,
to here right now.
Dan, let's give Matt the last 30 seconds because we do have to go here.
Yeah, I would just.
We got things going on at lunch too.
All right. Well, I would just add that I think a lot of the reason it's difficult is because there is so little consensus, even among people who are paid a lot to be right about it. And that is why it's so fundamentally challenging. I mean, having been in the mainstream media, one of the fun things about covering economics is the fact that people don't, there isn't a consensus, and you can really see what all the disagreements are among people who, have a lot invested in it. So that I think is really the root challenge. So if once the experts understand it better and have a consensus, hopefully that's the first step, and we haven't gotten that yet.
Yeah, that's a great point. We have to have better policy along with better communication of which policies work. Well, thank you all. I know this is a big topic, and we didn't solve it today, but hopefully you have a better understanding of some of the dynamics and debates that inform the inflation debate. And as Dan said, he's volunteering himself to stick around, and we do have a little bit of a break before lunch. So thank you all.